When you open your 401k menu, you usually face a choice. On one side, you have actively managed funds. These are run by teams of highly paid professionals sitting in rooms like this, and their entire job is to beat the stock market. On the other side, you have an index fund. It is practically automatic. It simply buys a tiny piece of every major company, and then it does absolutely nothing. This diagram compares 100 of those expensive expert-led teams against the automated approach. Over a 15-year timeline, 92 of them fail to beat the index fund. That is a verifiable, repeated outcome. Over the time frame that matters most for your retirement, 9 out of 10 professionals lose to a fund that barely tries. Making the wrong choice here quietly drains thousands of dollars from your account. So you might look at those odds and think, fine, I will just find the 8%. I will pick the manager who actually wins. Researchers tested exactly that. They took the active funds that landed in the top 25% for a single year and then checked back to see how many maintained that performance a few years later. This chart tracks that top tier of funds over time. As we roll the calendar forward, the number of funds that stay at the top drops to 0. Not a single top-performing fund from 2020 stayed in the top quarter by 2024. The industry hides this failure rate through a process called survivorship bias. When a fund performs terribly, the company quietly shuts it down or merges it into another fund. The bad record vanishes, leaving only the survivors on the glossy marketing brochures. When you chase last year's top performer, you are buying a temporary hot streak, and hot streaks always end. Their eventual failure is driven by cold, inescapable arithmetic. The man who proved this was Jack Bogle, who launched the first retail index fund in 1976. He called it the cost matters hypothesis. This diagram represents the entire stock market. Because every share is owned by someone, the market is populated entirely by these individual blocks. Before fees, all investors added together must earn exactly the market's return. They match perfectly because collectively they own the market. But participating in the market costs money. Every dollar a fund spends on trading costs, research, and management fees is subtracted directly from that collective return. An actively managed fund typically charges between 1% and 3% of your total money every single year. A simple index fund, by comparison, often charges less than 0.2%. The math is absolute. After costs, investors as a group must trail the market by the exact amount they paid to play. The group cannot beat the market because the group is the market minus the bill. Let's run the actual numbers. Imagine 2 neighbors who each start with $20,000 and invest $500 a month for 30 years. Both earn the exact same gross return of 7%. There is only one difference in their strategy. One neighbor chooses an active fund that charges a 1.5% fee. The other chooses an index fund charging 0.1%. This graph tracks their balances over 3 decades. The top line shows the index fund investor, who finishes the 30 years with approximately $600,000. Now look at the active investor. Their account plateaus closer to $460,000. That gap is roughly $140,000. It did not buy a single extra dollar of gross performance or better stock picks. That missing money was entirely consumed by the mathematical headwind of the fees. By paying a premium for a human expert, the active investor simply guaranteed a smaller final balance. If the arithmetic is that unyielding, why does almost everyone still reach for the expensive active fund? We are wired to believe that effort and knowledge create better outcomes. You want the mechanic who knows engines, and you want a surgeon with decades of experience. But the stock market does not behave like a broken engine. It functions like a massive collective crowd, and no single expert reliably outsmarts the entire crowd year after year once you subtract their bill. Investing is one of the few places where paying someone to try harder mathematically decreases your wealth. The financial industry knows this. They use glossy 5-star ratings, data-mined lists of past winners, and confident managers on television to trigger our natural respect for expertise, ensuring we keep paying their tolls. The winning move is to choose boring on purpose. Own broad, low-cost index funds that simply capture the return of the whole market and refuse to pay the fee. Then comes the hardest part of the entire strategy. Do absolutely nothing. Stop checking which manager is hot this quarter, and stop switching funds to chase last year's winners. Over a lifetime of saving, the market does not reward activity, and it does not reward confidence. It rewards the patient and the cheap. The question was never whether you are smart enough to outguess the stock market. The real question is whether you are finally willing to stop paying Wall Street to lose for you.